Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me from the Bangalore studio is Ritu Singh, and these are the top headlines from the startup world. Twitter informs its staff that layoffs are set to begin starting today. Reports say that a class action suit has been filed against Twitter, alleging that the company was sacking staff without adequate notice. Elon Musk's company is reportedly planning to fire 50% of its workforce.
Large-scale layoffs across all functions at Twitter India, sources tell CNBC-TV18. The engineering team, the largest team in India, sees the largest cuts. A letter to the employees laid off in India says they're conducting a workforce reduction to help improve the health of the company.
B2B e-commerce unicorn Udaan announces a second round of layoffs, citing macroeconomic conditions. The B2B firm has laid off 300 to 350 employees in a bid to turn profitable and achieve efficiency, a company spokesperson told CNBC-TV18.
Tech companies in the US are laying off hundreds of employees and freezing hiring processes in response to concerns about the economy and future financial uncertainty. Payments giant Stripe will slash 14% of employees, or 1,100 jobs, while ride-hailing firm Lyft is going to cut 13% of its staff, or nearly 700 jobs.
PayU signs the world's most expensive football player, Lionel Messi, as the global ambassador for its social impact arm, Education for All. The EdTech company is targeting a profit by March next year and has announced plans to lay off 2,500 employees.
Apple led the premium segment in India with 40% share, followed by Samsung and OnePlus, with registering highest ever shipment share in the country in the September quarter. Apple reached its highest ever share of 5% in India's smartphone market during the quarter, driven by a strong channel push ahead of the festive season.
Well, those are the headlines that we're tracking for you this evening. Now, straight to the top news today. The job cuts at Twitter have begun. The hashtag Twitter layoffs has been trending since morning, and several employees who have been laid off have been tweeting about it. Yash Agarwal, who was working on public policy at Twitter, confirmed that he has been laid off in a rather cheerful manner. But sources say a large majority of Indian employees have been laid off. Ritu, what's the latest that you're picking up?
Well, Twitter's letter to employees in India who were laid off, very clearly shows that the company is saying it is in the middle of improving the health of the company, and therefore these steps have been taken. We're given to understand that there were large layoffs at Twitter in India, and these have impacted almost all functions. The tech or the engineering team is the largest in India. They've been the worst impacted. Marketing, communication, no department has really been spared. Now, in this letter that was sent to the employees that were laid off, Twitter did say these decisions are not easy, but their role had been identified as potentially impacted or at risk of redundancy, and depending on the country in which they live in, the next steps would be laid out to them. Immediately after this letter was sent to the employees of the company earlier this morning, all their access to Twitter systems was cut off completely. And, interestingly, it says that it does not mean that their employment had been terminated. So we have to see what exactly that will mean, because Twitter is still asking these laid-off employees to continue to comply with the company policies, including the code of conduct to maintain confidentiality. Additionally, there was a message sent to them on Slack which said, given that it was their last working day at the company, they will remain employed by Twitter and they will receive compensation and benefits through their separation until the 4th of January next year, and that within a week they will be receiving details of their severance offer, financial resources, which will extend beyond the non-working notice period as well. So that's as far as Twitter India is concerned, Arundhati. Now, we also understand, this has impacted, a large number of employees. Still to get a final number on that.
Absolutely, Ritu, and we'll wait and see what happens then. It's not just Twitter, actually. The current economic conditions are forcing several tech giants at Silicon Valley to tighten their belts, and the Indian tech companies are not immune either. Abhishek Dattaroy decodes the new phase of tech austerity across the world. Take a look.
Elon Musk, Twitter's new owner and its complaint hotline operator, by his own admission, may not want to take frantic calls from employees as his company starts implementing cost-cutting measures. As per reports, Twitter plans to lay off close to 50% of its staff starting today, ticking off yet another item on Musk's to-do list. Reports of imminent layoffs have been doing the rounds ever since Musk took charge of Twitter. An internal mail addressed to employees last evening read, and I quote, "In an effort to place Twitter on a healthy path, we will go through the difficult process of reducing our global workforce," end of quote. The email also says staff members will get notices either through their company email accounts if they still have jobs or their personal email accounts if their employment is impacted. Twitter also forbade employees from discussing confidential company information on social media. Twitter is only adding to the wave of layoffs across tech companies in the Valley and across the world. A host of others, including ride-hailing app Lyft, online real estate company Opendoor, fintech companies Stripe and Chime, are also handing out pink slips. According to the San Francisco Standard's layoff tracker, more than 16,000 workers have been laid off at 138 San Francisco-based companies since January of 2022. Many of them happen to be tech companies. So why exactly is the tech ecosystem pruning its workforce, tightening its belt all of a sudden? A quick glance at emails sent to employees by some of these companies, and there is a commonality. Companies are bracing for a recession in the US, pulling out of less critical initiatives and trimming their outlook on growth prospects of the internet economy. Back home, after Baiju's fired 2,500 employees in a bid to target to turn a profit by March next year, the company's founder Baiju Ravindran said this is a huge price to pay for walking on the path to profitability. But this hasn't deterred the nation's largest edtech firm to announce that they've onboarded Lionel Messi as their global brand ambassador for equitable education social initiatives. The company has not disclosed how much they had to shell out to sign the football superstar. Baiju's isn't the only company cutting jobs. Unacademy has laid off more than 1,000 employees. White Hat Junior, Vedantu, Lead have all announced job cuts. Even big tech is struggling. Shares of Facebook's parent, Meta, are down more than 75% from record highs. Amazon has imposed a freeze on corporate hiring as the global outlook for economic growth remains grim. The tech industry is certainly tightening its belt across the board. With Abhishek Datta Roy in Mumbai, this is Shireen Bhan.
And adding to the slew of layoffs, Tiger Global-backed startup unicorn Chargebee has laid off 10% of its workforce as it restructures its organization amidst growing operational debt and global macroeconomic challenges. That's not all. Tiger Global has halted its investments in China's equity market. A Wall Street Journal report says that the company says it plans to reassess its exposure to the country after President Xi Jinping getting a historic third term.
Well, Arundhati, you've named several companies, and that wave of layoff among the tech companies and startups in the US and, of course, back home here in India, that continues amid the funding winter that seems to have well and truly set in. Now, what's behind this, and is there light at the end of the tunnel? Joining us now to take this discussion forward are two guests, Ramani Datti, the CFO of Teamly Services, and Ankur Bansal, the co-founder of Black Soil. Gentlemen, thank you very much for your time on Startup Street. Let me start with you, Ramani, because, we've seen some surveys that suggested that there was a 61% drop in the number of permanent employees that startups have been hiring over the past 1 year. Give us the numbers that you have. What is, with the recent spate of layoffs that we've seen, how many have been impacted?
Definitely. So that's the kind of data point that we also have at our end, that there is almost a 50 to 60% drop in new hirings of startups compared to last year. So over the last 2 years, ever since COVID hit, IT industry, we have seen the maximum demand for IT staff, and the voluntary attrition was also very high. And a large part of that IT attrition was absorbed by the startup industry, but now those hirings we have started seeing tapering down. So maybe in a quarter or two, once this voluntary attrition, which is currently being absorbed by startups, also comes down. So then, at this point in time, we have no visibility on if both IT services, product companies, and startups are all going to be on hiring freeze. So what are we going to do with the new placements that we typically do month on month?
All right, Ankur, hi, Arundhati here. Let me bring you into this conversation. Now, EdTech has been a clear standout when it comes to layoffs among startups. Now, which other sectors have been most impacted and which ones have remained resilient at this point in time?
I believe any sector, or actually more than sector, is more driven by companies which had over a lot of liquidity flowing to them. That has resulted in a lot of issues from growing at any cost, and not focusing on unit economics. And now that's the reason now many more companies across sectors. You have given example of ChargeBee, which is on the SaaS segment side. We looked at Udaan, which is on the B2B e-commerce side. Both are very heavy in terms of the kind of equity investments that have gone into the space. We continue to see that there is going to be tightening of belt across the sectors. So it's not just one or two companies that we are hearing of, but across the space, more and more startups are now very clear that they have to ensure they reach to the path of profitability very clearly from their current investor base as well as from a sustainability perspective. So it's the excess liquidity that was happening in the markets for the last 2 years has now started to see some of these consolidation phase that we have entered, and I don't see it changing anytime soon. From sector's perspective, anybody who sort of was selling a product or service for which a client or any customer was being paid or was given for free is basically the business which is most impacted as a business, right? If a client or a customer is not paying you and you're offering it, then obviously it makes not much sense from a business itself. Though you might be growing 30-40%, but finally there has to be something the investor should be able to see on the P&L level.
Well, there definitely is a lot of pressure from investors and grow at any cost, like you said. That's been a trend that we've been seeing. But Ramani, let me come back to you. What have companies that you've been talking to have been saying about their future hiring plans? Will we see a lot of these hiring plans being put on hold, or will we see some sort of growth, but perhaps at a slower pace?
Yeah. So currently there is a hiring freeze across all IT services and some of these large startup companies. For the time being, the visibility is that this hiring freeze will continue till 31st December. So maybe starting from Jan, we may see some kind of positivity, but at this point in time, we have no visibility on that front. Also, one thing which we are hearing from the companies is over the last 2 years, the salary inflation, especially for tech resources, is at all-time high. It's almost like 30% year-on-year salary increment has been factored in for the last 2 years. And now companies are trying to optimize and reduce their costs. So they are trying to increase the productivity of their existing base, letting go some of the mid and senior level employees and focusing more on bringing their freshers and entry-level talent to full productivity. So that trend can continue for the next couple of quarters as well.
All right. Ankur, what is the sense you get when you talk to these startups? Have we seen the worst of this phase, or is there more to come?
No, I don't think we are at the end of the consolidation phase. We are still, I think, I would not say even in the middle of the consolidation phase. There is still a lot of work yet to be done. And obviously businesses which were not very attractive from investors' interest in the past because they were profitable possibly, but not growing at that pace, has now started looking very exciting to many of the investors. So the trend is changing very rapidly. Unless in like 6 months we start seeing huge amount of equity inflow start coming again, because finally all the investors are sitting with a lot of dry powder. India is an attractive destination. Unless that trend changes, we are going to see some more belt tightening happening over a period of time. And some companies which were fundamentally flawed will obviously have to consider getting into an M&A kind of situation if they were to sort of see the light of the end of the tunnel. So there is going to be more pain. It's not changing anytime soon as per whatever the kind of startups we are currently working with.
Ankur, I take your point that there is going to be more pain. It will be some time before we see light at the end of this tunnel. But if you were to put on your investor hat with which you scrutinize these companies, and I'll quote, the letter from the Stripe CEO, which is quite interesting. It talks about 3 reasons why we're seeing this kind of meltdown. One is, overestimated digital impact of the pandemic. 2, the companies are not able to absorb the cost that now that capital is tight. And thirdly, traditional companies are catching up very fast with these startups that had mushroomed in the last 2 years. What, to your mind, are the key domestic factors because of which we're seeing this kind of a meltdown in Indian startups?
I think one of the guys, as mentioned earlier, excess liquidity sort of has been one of the biggest reasons, because many times people don't focus on solving the problem in a frugal manner. You try to throw money at the problem. And because the way to throw money at the problem is hiring more people instead of, sometimes building on technology front. So the key fundamental issues in the business model itself results in some of the issues that we are seeing in some of the businesses. Though I would see consolidation is happening across the space, so it's just not edtech. Of course, there is a over exuberance that had gone in the edtech space as such. But the heavily funded companies typically have been able to raise money very quickly, have generally had a more difficult times versus businesses which were in the middle, and they are finding it much more easier because they never got that kind of capital. So from a business analysis perspective, it's typically driven by which companies have had a lot of investor capital flowing to them, because of which sometimes they have gone on an expansion mode, and as a result they got into areas which are not of interest, and those areas now they realize are not core to them, and that's the result. They end up doing layoffs. So the core business, if it's strong, they will again bounce back very strongly. But if the core itself is an issue, then it becomes a larger problem, because they need to start looking at pivoting and trying to make revenue and trying to make profitability from other sources which the core is currently not supporting from.
All right, we'll leave it at that. Ramani and Ankur, both of you, thank you very much for your time here on Startup Street. Thank you. Well, now, it's a setback for India's fintech industry. That's the first word in from Billdesk's co-founder on the aborted $4.7 billion deal with PayU, which would have been one of the largest in the fintech space for India. Now, I spoke to Srinivasu MN, the co-founder of Billdesk, who said these turn of events could well create a trust deficit on how Indian companies view foreign investors.
Whenever there is something for us to talk of in public domain, we will do that. Else we will tend to act behind the scenes as we normally have done.
No, surely it has come as a disappointment for the industry as well. It was the largest deal in the fintech space in a long time to come. There have been reports that you would also pursue legal action, to get some sort of compensation fee because of the deal being called off after all of this time. Any comment on the matter?
So all these reports have been without any reference to the company or quotes from the company. I think the media has speculated, but we'll need to see what happens. Yes, it has been, I think, a disappointment for the industry, and I think it's also been a setback from a fintech industry perspective of what would have been a large deal and the manner in which it was perhaps called off. So we'll just have to wait for time to see how this evolves.
Could you tell us whether it was, the delay in the closure? Because we want to understand from an overall point of view, is it regulatory clearance, supply fluctuations? What really led to the demise of the deal?
I think we all know as much as is in the media domain. There's nothing more that I can add to that. And as I said, if there are actions to be taken, we'll see that going forward.
Do you think the lack of this deal going through, it was one of a large global company investing into an Indian company and it had big plans there, will be sort of a dampener when it comes to foreign investors looking at doing deals in India, looking at the ease of doing business in India? Do you think it'll have a wider ramification than just one deal falling off for two set of players?
I would think right now the bigger implication is for how does any entity transacting in an M&A deal rely on a buyer of that nature to stick to the deal. I think that's a bigger ramification than saying how do people look at India. I don't think that's impacted. India did its job in terms of regulatory clearances to asking the right questions. So I think the implication is more from how do Indian companies look at foreign investors sticking to their word.
What next for Billdesk? After this PayU deal did not materialize, what are you looking forward to next?
That was a shareholder deal. So for Billdesk, nothing changes. We continue to kind of play a lead role in payments as we have done, and we continue to grow our business.
Are you at all worried about the regulatory environment? There's been some concerns from the fintech space, about the slew of regulations impacting some of the business models. Do you think, is it a bit of an overreach, or, what is your overall view? Will the system emerge stronger?
No, we've been very welcoming and supportive of the regulation that's come. I think that's extremely good for the Indian market, especially in the fintech area, right? Most regulation has been towards consumer protection. We've all had to implement them at a quick timeline basis, and I think they're all good in the longer run for the Indian fintech space.
On that note, it is time for us to head into a short break. But coming up next, cashback and coupon startup Cashkaro bagged 130 crore rupees in a Series C round of funding led by Affle Global. We will be joined by the co-founder Rohan Bhargava to talk about the fund allocation plan and a whole lot more. Stay tuned. Welcome back. You're still with us on Startup Street. Cashback and coupon startup Cashkaro has bagged 130 crore rupees in a Series C round of funding led by Affle Global. The startup has now raised a total of 255 crore rupees and is backed by investors like Kalari Capital, Ratan Tata, Korea Investment Partners, and others. Joining us now to discuss the fund allocation plan is Rohan Bhargava, the co-founder of Cashkaro and Earnkaro. Rohan, thank you so much for joining us on the show today. You've raised 130 crore rupees. How do you plan to use these funds? It's going toward expanding your business both in Cashkaro and the other businesses that you have.
Absolutely. Firstly, thank you for having me on the show. I think, with all the conversations that have been happening around, companies laying off people, companies sort of trying to figure out how to get to profitability, I fundamentally think that this is an area that we play a very, very core part. While we talk about the use of funds, the core business value proposition that we bring to our partners, people like Amazon, Flipkart, Myntra, Ajio, et cetera, is really about, can we solve marketing as a problem? Today, if you talk to most companies, a lot of the capital, a lot of the money that they're raising is really going towards how do they get customers at a cost that makes sense for them. And that is the fundamental problem that we're out to solve. If you think about how traditional marketing has been done, money is spent or customers are acquired on a cost per click model. And that is the fundamental status quo that we've defined, right? So we've said that, look, we need to move marketing from a cost per sale model, from a cost per click model to a cost per sale model. So we only charge our partners like an Amazon for sales, right? And not for traffic or clicks that we generate to them. Now, on the user front, what we're doing is we're allowing these users to not only discover lots and lots of different brands, but we're also allowing them to do price comparison, discover new brands. And then the big icing on the cake is on every transaction that they do, they end up getting a cashback. And that's the core value prop, right? And that is, I think, why this model works really well. And that is why, we have, been able to raise capital in what is a fairly tough economic market. Now, when you talk about the use of funds, when we look at the product that we have built, we're effectively giving you free money, right? We're giving you money for doing what you're going to do for shopping online. And the question we kind of constantly battle with ourselves is that why would every Indian shopper not use Cashkaro? And the use of funds is really towards, increasing the brand awareness, letting more and more Indian e-commerce shoppers know that we exist, and that, just by using our wonderful platform, you can now get money back. Obviously, there is, it's important as we keep scaling and growing to get more talent.
Got that.
So it's really brand awareness, talent, and product. That's where the use of funds are going to be.
Rohan, briefly, if you could tell us about your financials. We know your revenues crossed about 200 crores in the previous financial year. Your GMVs are about 4,000 crores. Give us the near-term visibility, and also, is the company profitable yet?
So if you look at the last 2 years, we have grown from a revenue of doing about 100 crores to 225 crores as of last year. That's a 100-120% increase in numbers. Now, we have achieved this number while keeping our loss number at 10 crores. So when we were doing 100 crores, our loss was 10 crores. When we did 225 crores, our loss was still 10 crores. And I think that really speaks to how we have continued to drive this business. We want to drive this business towards profitability. If I look at the current year and the trends that we're seeing, we're again seeing an extremely healthy run rate, and I don't think our losses will be greater than what we've seen in the past few years. So that's the current financial run rate.
All right. Now, can you talk to me about the kind of traction you've seen for Cashkaro so far? You're looking to grow your user base from 20 million to 100 million over the next few years. So talk to me about how you plan to do this.
I think there are a few factors that play in, wonderfully for our thing, right? Now, obviously, having raised 130 crores, it gives us a lot of firepower to go out and use various marketing channels that exist to drive brand awareness. We also believe that a lot of the growth that we see right now through our business is coming through word of mouth, right? So when people use our product and they realize that there is actually a core financial benefit that they're getting by using us, they end up talking about it. The referral is probably one of our strongest source of new user acquisition. So somebody who uses our platform, gets money back, is now actually talking to their friends. It's a service that people want to tell their other friends about, tell their family about. So I think our path to growth is going to be one driven by the 20 million customers we have and getting them to talk about us, doing a lot of brand visibility campaigns that allows us to get to the next level, And then I believe that the network effects in our business will really start to kick in. People will start to talk about it on their own. So that's kind of the path that we see going from 20 million to 100 million.
Rohan, what's really your moat, though? I mean, it is a competitive industry at the end of the day. What kind of new products are you looking to launch with this capital that you've been able to get that'll set you apart from the others? Because, you know, there are plenty of players in the market.
So I'll tell you how we build the moat, right? Today, when we look at the value that we're able to drive to our partners, so let's say if I look at a brand like Ajio, we're now a very significant marketing partner to them. Now, there is a certain marketing fee that we get, and some part of that is what we pass as cashback. Now, because we're hitting a certain scale already, our ability to command a certain marketing fee for them keeps growing. So anyone who starts to compete with us is starting from probably the lowest slab, right? And because, you know, as the economies of scale kick in, right, we're able to create a significant moat there. Now, along with this, we've also built a number of other products, right? So today we have Cashkaro as sort of the flagship product, but we've also now built a product called Earnkaro. Earnkaro is a product that is built on referral marketing. So what we're doing is we're enabling people to effectively use our platform to earn money. So for example, let's say that if you wanted to earn money so let's say if you're an influencer and you're promoting, let's say, fashion products. Today, how do you monetize that? How do you monetize that influence? And Earnkaro is a platform that allows you to do just that. So you can effectively copy any e-commerce link, drop it into Earnkaro, and it gives you a unique referral link. Now that opens up a very vast marketing channel where influencers are now effectively promoting our marketing partners. In addition to this, we've also moved towards the rural India side with the advent of something called Cashkaro stores.
Right.
In this case, what we're enabling is people who are, you know, wanting to be part of e-commerce, but they're not comfortable yet shopping online, or they're not comfortable making that online purchase. We've now built a massive network of almost 20,000 Kirana stores who enable this to happen.
So a whole host of products there, but we're completely out of time. And thank you so much for joining us on the show today, and we wish you all the best going forward.
Thank you so much. Thank you.
On that note, it is Friday and it's time to take stock of how the startup space fared this week in terms of new deals. 16 new deals took place this week, valued at over $270 million. Some notable deals include media tech company Amagi, which bagged $110 million from General Atlantic. Clean tech startup HygenCo raised $25 million from SBI Cap Ventures. Electra EV also got $25 million from GEF Capital Partners.
And that's not all. Lenders to SMEs Kinara Capital raised $24 million from British International Investment and Triple Jump, and D2C sleep tech startup The Sleep Company backed $21.3 million from Premji Invest, Ulterior Capital and Fireside Ventures. Overall, the startup world has seen over 1,000 deals this year, valued at over $22 billion. On that note, we're going to wrap up this edition of Startup Street. Thank you for tuning in, but stay with us. More news and updates coming right up after this break.